Okay, we are at the top of the hour and just want to welcome you once again to our today's webinar, Baby Boomers, Millennials, and Wealth Transfer, What You Need to Know. My name is Sean English. I'm the Director of Content Development here at CSI, a Moody's Analytics company. Pleased to welcome you today to this webinar. It's our first webinar in our four-part series that celebrates Financial Literacy Month. Our goal with these webinars is to provide Canadians with education to help them better manage their finances. And as baby boomers continue to retire en masse, retiring Canadians have worked a lifetime to build their net worth. Many are set to be part of the biggest transfer of wealth in our history. Today's webinar will provide insights on how Canadians can best prepare for a smooth intergenerational wealth transfer by working with a qualified advisor on creating a plan that protects what matters most to you and your family. Now, before we begin, there's just some housekeeping. Today's webinar is being recorded. The ratings, financial analysis, projections, and other observations constituting part of the information contained herein are and must be construed solely as statements of opinion and not statements of fact or recommendations to purchase, sell, or hold any securities. We strongly recommend you speak with a qualified financial advisor regarding your own unique circumstances. We ask that no one record this webinar without Moody's explicit written permission. Lastly, no one has permission to quote any of the comments made or questions asked by the webinar audience. All members of the audience are currently on mute. If you have a question, and we encourage you to do so, please type it in the Q&A box on the lower right-hand side of your screen. And we ask that you please keep your question as generic as possible, and please avoid any personal or client-specific information. Now onto the webinar. I'd like to introduce John Pappas, who will introduce our panel and host today's session. John is the Senior Director of Business Development and responsible for CSI's B2B strategy. He has been in the financial services industry for over 25 years and occupied several roles: portfolio manager, senior account executive, advisor in private banking, and an economist. And in his spare time, John is a professional musician and designs and builds custom guitars. So over to you, John. Next slide, please.
Thank you, Sean. Thank you for the generous introduction. I would like to take a moment to welcome all the participants to the session today, wherever you are located, whether it's on Eastern Time or in Western or Eastern Canada or even elsewhere. We have an hour chocked full of interesting information that we hope to get out to everybody. So I look forward to some of the questions as per the methodology that Sean laid out. The format for today's session will be our three panelists will each be asked an individual question. They will have roughly about 10 minutes to respond to that individual question. We will move to a fourth question that will be open to all the panelists. And then finally, Sean will respond to the importance of finding a credential advisor. So I'd like to take a minute right now to introduce all the panelists to you. From the center of your screen to the right, first up, we have Julie Sabaris, who joins us from TD Wealth. Julie is a senior manager of wealth planning support. Then we have Evan Parabetz, who is an investment specialist with Steady Hand Investment Funds. And finally, we have Colin White, who is with White LeBlanc Wealth Planners and is a portfolio manager. At this point, we'll move on to the first question. Next slide, please. First question for you, Julie. What should Canadians know about intergenerational wealth transfer, and why is it important?
Thanks so much, John. So what we know is that the stats show that about 25% of Canadians have a will. So what that means is about 75% of you who are watching this panel discussion right now do not have a will. So I hope that one thing that you do take away from this discussion today is a commitment for yourself or for your family, your parents, etc., to get that will into place, because that is absolutely the foundation of this. So reasons that are cited for not having a will: too young, not enough assets, or it could be too expensive. So what I have to say to this, as much as we all wish that we could live to our life expectancy and hope that we do so, the reality is that may not be the case for some of us. I know that personally, my sister passed away in a car accident at age 22 unexpectedly, and unfortunately did not have a will. When it comes to too expensive, what I have to say about this is it's generally going to cost something in the neighborhood of about $1,000 for a will that doesn't have a lot of complexities. But what I will tell you is if you don't spend that $1,000 now, the costs down the road are going to be much more. So let's get into what that might look like. If you were to pass away without a will, you will have died what's called intestate. And so in these circumstances, what's going to happen is that the province has decided for you how your assets are going to be distributed. And not only that, somebody will need to apply to the courts to be the executor. And so this process, even when it's most straightforward, will cost thousands of dollars in legal fees. It will take approximately 4 to 6 months in a good situation to start to get control of those assets and start to dig into the estate. In that period of time, you have to sort of potentially be running a house, keeping the bills paid, these types of things, which can be very difficult. And so, what you want to do is just make sure that this is in place so that your family does not need to deal with this when they are in a period of grieving. So I'll share with you a story of, when I had to look after the estate for a cousin of mine who unfortunately passed away. It cost me $10,000 in legal fees. It cost me approximately $20,000 to keep her house running until I could get control of that estate. Had she just paid the $1,000 to get a will, we would not have ended up in this situation. The next item that I want to cover is just the costs of passing away that are often overlooked. So something like probate is going to kick in. Now, this is a term that we may be familiar with, and this is generally still look after dollars until I could get not event that are familiar with. And this is generally a one-time percentage points. In Ontario, we're looking at about a one-time cost of 1.5%. But the biggest piece that's overlooked often is taxes. So when you pass away, your assets are deemed to have been disposed of. Now, there's some opportunities that we can roll over to a spouse without triggering those taxes. But that's only deferring those taxes. So we want to make sure that those taxes are planned for. So what we need to consider is things like if you own a non-registered stock portfolio, that's deemed to have been disposed of and those capital gains start kicking in. Let's say you have a family cottage, same thing. So plan for these expenses. Make sure that you've put the necessary plans in place. And this can include things like insurance products, so that you know how the assets are going to be distributed to your beneficiaries, factoring in those taxes. The next piece that I want to touch upon is going to be family dynamics. And so, every family is different. And so what you want to consider is what are the needs of your family and those different dynamics that you want to make sure are captured in your estate plan. So the first thing is just the definition of a spouse. When it comes to estate planning, different definitions of a spouse can kick in. We have a definition of a spouse under the Income Tax Act. We have the definition of a spouse under pension legislation. We have the definition of a spouse as it applies to family law. And just because you're filing your tax return together as spouses does not necessarily mean that that person will be recognized as your spouse when it comes to estate planning. So we have blood relatives, we have chosen family, we have blended families, and you want to ensure that you have factored this into your estate plan so that your loved ones are provided for. And then you also potentially want to consider the next generation. So let's say we have a situation of a blended family. You might want to provide for your spouse, who is potentially your second spouse, but then those assets, once that spouse passes away, you want to make sure it goes back to your children. And these are circumstances that are very common, but often not planned for. The other consideration is this concept of fair versus equitable. And so, you want to be considering what's fair for your beneficiaries, but that does not necessarily mean equal distributions across the board. And even how those assets are distributed might not be the same. When working with families and their money, you often see that there's disparities and variances amongst their children and their ability to handle an inheritance. And so you may feel comfortable giving the assets outright to one child, but not the other. And potentially additional plans need to be put into place. So these can be things like trusts, that you can control the distribution, but also making sure that this is part of your estate plan and your will, where you've mapped out what you want for your children and those assets to be distributed is really key. Keep in mind, your estate plan should be a dynamic document. It is updated over time, and you need to make sure as your life changes and your circumstances change, that you are updating your estate plan to reflect that. So also what we can get in estate planning very often is unintended consequences. And this is why you need to make sure that you are working with a professional and they need to take a look at the full picture. When it comes to estate planning, the answer is often, it depends. And it depends because there's a variety of other circumstances and considerations that come into play. So the more that you can be forthcoming with the professional that you're working with and be clear and declarative about your intentions and the ability to look at that full financial picture, the better off that you are going to be, because then we can start to get ahead of potentially those unintended consequences. And also it's important to have this dialogue with your family and your loved ones about your intentions and what do you want. And that really helps minimize any friction or disputes that may result with family and loved ones if this is not mapped out in a clear, concise way. Back to you, John.
Thank you, Julie. The very in-depth response. I have a couple of follow-up questions. One on the subject of intestate that you mentioned earlier. Can you elaborate on that a little bit from the perspective of, is there a formula that's applied by the state, or is it judged on a one-to-one basis in terms of the distribution? How does that actually work in reality?
So it's sort of a one-size-fits-all approach. It is different province by province, but really they're only going to consider essentially, legal spouses as well. So actually married spouses, as well as other blood relatives, such as children, grandchildren, siblings, and parents. And so there will be a defined formula. This amount is going to go to this person. Should there be assets in excess of that, then it goes to the next level. This may or may not be aligned with your wishes. Maybe you have a sibling that you don't really like all that much, but the province has decided, based on their formula, that the money is going to them. And so, it's really important to put those plans in place so the province is not dictating for you how your assets are going to be distributed.
That makes sense. Thank you for that. One other quick follow-up question here. With regards to prenuptials or cohabitation agreements, are they a good idea for couples to enter into? And what is ultimately the impact, or if there is any, in fact, around setting up wills post cohabitation or prenuptial agreements?
So these types of agreements, I absolutely recommend them. I think they're very important, especially, putting these types of agreements in place when things are good in the relationship, because, it's when things go bad in the relationship that, sometimes issues surface. And so we want to make sure that there's an agreement in place that already determines how this is going to go. But I will say that those are separate from an estate plan. Those agreements are really, while everybody is surviving, and they wouldn't come into play in an estate situation. It really would come down to the will.
Right. Perfect. Thank you so much for that. We'll move on to the next question at this point. Julie, thank you for your responses. So the next question here is for Evan. Evan, what are some common themes or challenges that you've noted amongst your clients with regards to wealth transfer?
Thank you, John. Well, there's several themes and challenges, and Julie's actually done a great job outlining many of those already. To begin with, the timing of wealth transfer, Julie has spoken about intestate, and even for those who don't actually pass away without a will, sometimes they just plan far too late, and there could be a lot of planning tools that you could have done if you had done a will and estate planning earlier in your life. Some examples are gifting while you're still alive to your beneficiaries or your children, spreading tax liabilities over a longer period of time, or charitable tax planning, amongst a host of other type of planning that actually needs time to carry out. And if you do a will very last second, it's unrealistic that it'll be done. When the process of doing a will and planning wealth transfer does begin, often the individuals are more looking at how to achieve it rather than what they want to achieve. So the technical aspects of it, for example, I need to save taxes. Well, yes, you want to save taxes, but you ultimately want to do, what are you trying to do with this money of yours? Who are you trying to give it to? How do you want it done so it's fair and equal? And on that note, you'll often get this conversation going between what is considered fair and equal. Some people believe that all children should have a same amount no matter what, just to be equal. But what if one child is going to go to expensive university and you are looking at gifting before you pass away? In fact, I have a client in that very situation right now where they want to go to a university in England versus another who's staying in Canada. Should that person get more? Should the other get less? Or if you're trying to help with things such as an RESP for the grandchildren, what about those who don't have kids, or ones who have more and ones who have less? So looking at gifting, looking at what's fair and what's equal is not technical. It's the opinions of the parents, or of what they want to do when they eventually pass away, or if they want to transfer assets while they're still alive. What's important is often talking to the children. There's often a discomfort between the parents and children talking about death. My dad's in his late 70s. He didn't do his will until his early 70s, not for lack of convincing. I really tried over the years, but he finally did it. And I think a lot of people can relate to that. It's something parents often don't want to talk about with their children, especially. Children often just don't even like to think of the idea of their parents passing away. But it's so important for the two to get together and speak, because they could have very different views of what they want. Sometimes the parents think they know what the children want, and it doesn't necessarily align to what the children actually do want. I have this quote that I'd like to share. It's from a colleague of mine, Sandy Martin from Spring Financial Planning. And she said, the older generation and the younger generation have a responsibility to be genuinely curious about each other's value, and to be open and honest about what they value, what they want, and what they need. Avoiding these conversations out of a desire to avoid conflict is a knee-jerk reaction that both generations tend to have, and it's the wrong reaction. So just as it's so important to have a will, you don't want to die intestate for reasons already brought up. It's also equally important to know what the objectives are for your estate, and that often involves speaking with the individuals who will ultimately receive the money while you're alive or pass away. One example of where it was planned a little bit late, client did have a will, but they didn't have a power of attorney. And unfortunately, that individual did get Parkinson's, and they never did get the power of attorney until such time that he's no longer cognitive. And now they have to go through the courts and apply for a guardianship. So those are the reasons, not just for wills, but for power of attorney. You don't want to leave it to the last second. Finally, there's the investment aspects to what will eventually be transferred to the beneficiaries. Often people just think of all of their money as money that's going to be part of the retirement. And so it's treated as a retirement investment. Some are conservative, some are more aggressive, but they're not looking at their assets as some will be for me to live off for the rest of my retirement, and some will go to my beneficiaries. And there should be a discussion about treating those assets differently. That has a different set of philosophies. Some say, I really think I want to keep all the investments. I want to go to my children or a charity as safe as possible. I can't handle the thought of it losing value, and if something happened to me, they get less. Others feel, I'm going to be around for a long time and I want to grow it as much as possible, and so why not have it in more long-term type investments. So those are some of the things that we need to outline, the themes and the challenges. A lot of people, both in individuals and in the industry, they often look at the technical aspect. And I think while it is true, we need to look at the technical aspects of getting it executed. What comes first is what your objectives are with your money, what are your goals, and what are the goals of the people who are getting the money. Thank you.
Thank you, Evan. Thanks for the in-depth response. A quick follow-up question. You were mentioning gifting earlier. In your experience, and with clients in general, are you finding that more people are tending to gift their assets to their children while still alive, or are you finding that more people are becoming cognizant of the importance of actually having a will? Or is it a combination of the two?
It probably is a combination of the two. Having said that, I think there's more of a desire to do so. It's perhaps just demographics. A large cohort of baby boomers are now starting to think about it. There's also the reality of housing prices in Canada, in particular some of the urban modes, Toronto and Vancouver, where children may never be able to buy a house or will find it very difficult. And so there's the personal pressure of parents to be the bank of mom and dad.
Makes sense. Makes sense. Thanks for that. Okay, great. We will move on to the next question. Next slide, please. The next question is for Colin. Colin, how can Canadians best prepare, and what steps are required for an intergenerational wealth transfer?
Thanks, John. If we can move to the next slide. There's going to be a little bit of overlap in the answers to the questions here, because again, they're all very important points. Now, I was attracted into this field as an accountant 30 years ago, and I've stayed because the human side of this is way more interesting and challenging than the numbers. So, you're listening to an accountant talk to you about communication. So I'm going to share stories about how other people do it, because I wouldn't pretend to be an expert on this. But communication is key. Other panelists have touched on this, and from my own experience, families are families. That time that you and your brother had to fight when you were 6 years old, that can come back up later in life, and you're going to carry that baggage around. So it's if you can make it happen, get everybody in a room. You may need a separate room for the baggage. Everybody needs to leave outside and have a conversation. Now, sometimes families do that best on their own. They do it best in smaller groups. Then there's other times they need a moderator, and that's where a professional advisor can come in. So sometimes a moderated conversation. Now, as a sometimes moderator, going into a room and pleading a case and looking for somebody to, pass judgment on your dispute is not probably going to be helpful, but hopefully a moderator can help you find a little bit more common ground or look at things a little bit more fulsomely. Other situations I've had, and this is, challenging, and that the parents think that certain things are really, really important in their estate, and they're going to great lengths to make something happen. And I've had the opportunity to have the children also as clients and hear them say, no, I really don't care. And kind of in a bind because, again, confidentiality, I can't really share the two, but it's just an example where communication can solve some perceived issues as much as potentially cause more. But again, so communication is key, a moderated conversation. Now, again, you could have a great relationship with your lawyer, with your accountant, with your financial advisor, with your insurance advisor, somebody in your life who you feel comfortable with to sit down and help you have that conversation. When you're having communication and talking about the things, realistic is also something that creeps into this. Some people can get pretty particular with what they want to have happen. And life is a highway. Things are constantly changing. You're constantly dealing with, oops, the grandkids just showed up, or oops, I just had a fight with that member of the family. Again, things change over time. So the more specific you try to get at any moment, perhaps the more difficult you're going to make things for yourself down the road. We go to the next slide. Everyone's unique. Again, this is based on 30 years in the field. Just because your parents did things a certain way, or your brother did things a certain way, or you read a story about somebody, that doesn't mean that situation relates directly to you. This question is, what steps should I take? And my answer is, well, it depends which direction you're going. Chart your own path, chart your own course. Don't rely on 100%. An example, because again, if you're looking at somebody who's a much different age than you are, different economic circumstance, different family, all of those things are important. And more important is, what your perspective is. That's what you should be trying to get to. Now, I will say that some people find that daunting. It's like, I really don't know. I don't know what I really want. And that's okay. You're normal. That you don't have to have detailed answers to every question, but you should try to start somewhere. I deal with clients all the time who don't really have a finite picture on how they want things to go, but we do have a bit of a plan in place to try to make things as easy as we can, absent making any real detailed decisions. So it's okay not to have a comprehensive plan. I'd suggest that everybody needs the basics put in place, just to help things move more smoothly and be kind to those left behind. But again, you don't have to have answers to every conceivable question that is out there. So again, feel free to be unique. Feel free to chart your own path. And I'll give you an example. So, in being unique, if I'm talking with a business owner, and I deal with this, on the regular. So you've got a business owner, and they give their business, one of the children stay in the business, so they take over the family business, and then the business owner is left in the situation like, okay, I gave the business to my child. Child's perspective is, I worked and I earned it. So the business owner is saying, well, I need to equalize the estate to the other kids. Well, that's a very unique thing. And one of the panelists, I think it was Julie, mentioned earlier about fair versus equal. That is completely in the eye of the beholder. And sometimes what would help is to sit there and reflect with a professional who's maybe dealt with that situation a few different times and talk it out as to what are the different ways to look at that particular issue. But again, understand that your situation is unique and behave accordingly. Don't try to use a template, and just go through a checklist, except that things are a little bit different. One more slide, please.
Colin,
Oh,
sorry, quick question on that. Given that you have some experience in this particular area, and I'm a little curious as to, at least from your perspective, how do you manage through situations where there is some conflict within a family? Are you recommending that perhaps the individuals seek some outside mediation, or are you taking up that role on your own?
Well, it's a great question, John. I have, against my will, ended up taking on that role a few times, because when you're in the room and you can't get out of the room, you have to continue the conversation. Well, what I would say is that there's, I have limits. We all do. I'm not a lawyer. I'm not a therapist. But what I am is a professional advisor who has some perspective. Sometimes, in fact, I would probably say oftentimes, the source of the conflict is a lack of a perspective. There's a third, fourth, and fifth point of view that hasn't been considered because everybody's become so entrenched in only one way of looking at things. So, a good advisor can bring forth some alternative ways of looking at things. But you're right, at a certain point, once everybody's crying, then I'm going to say you should go find somebody to talk about this, because I'm obviously doing a bad job. So we all have limits, but I think the professional advising field can bring a perspective that does solve a lot of these issues.
Mm-hmm. Mm-hmm. Good point.
So
Thank
I believe
you.
I have one more slide. All right. Get professional advice, again, for the reasons that I've laid out here. And again, it's not always necessarily about technical knowledge. It's about having that perspective and helping you uncover things. Again, if you're not really sure, sitting down with a seasoned professional who can just ask you some leading questions and help you explore and figure out what really is important to you may be very beneficial. But the other point I would make is to keep it flexible. There's all kinds of situations where people get into problems now. The idea of early gifting of assets has come up, and that can be a very sound idea, but the unintended consequences can be if you give a piece of land to your son and after that he and his wife split, and all of a sudden there's properties being split or sold or things of that nature, because once it passes out of your control, then you lose control over it. So if there's a credit issue, child loses a job, child has matrimonial property, it can be very painful to be around to watch that happen. So you have to be careful about taking steps like that. When you do something like that, it is very, very final. So again, because perspective changes, because people change, because circumstances change, heck, because tax rules change, try to keep as flexible as you can with making your plans, and recognize that it has to be, reviewed from time to time. Julie made the comment that, again, it's not a static document, it's not a static conversation. And this should be a topic of conversation with your professional advisors semi-regularly. I mean, you don't have to, have a detailed review every 6 months as to your estate plan. That might be over the top and you might be compensating for something, and maybe you should look into that. But every couple of years, maybe, or every time your family situation changes, just have it somewhere in your head. And then once you've thought about it and you've documented it, put it away, forget about it, go live your life. And then, just have an idea, or maybe your advisor will bring it up to you. Hey, we haven't spoken about your estate plan the last couple of years. Does anything need to be updated? Again, recognize that you're unique, your situation is going to change, and try to keep your plans flexible. And I'll throw it back to you, John.
Very good, Colin. Thank you so much. I think at this point, we'll move on to the open panel question. One thing I would ask of the panelists, if you could all speak a little bit louder. We've had some requests from the participants that in some cases, you're not as audible as you could be. So if you could just speak a little bit louder, that would be very, very helpful for all the participants. So the next question is, what should clients ask of their financial advisors to help achieve and execute a smooth transition plan? So this is open to all of you, but I'll start with Julie.
Thanks, John. So really, this is going to be a two-way street between the advisor and the client. But the client should be asking their advisor to look at the full picture. And that kind of goes back to those things that I was mentioning about the it depends. When we start to look at strategies and situations in isolation, you can get those unintended consequences. And this can be assets not flowing as intended. This can be triggering taxes. There's lots of things that can come into play here. And so really it's about looking at all aspects, having a very clear dialogue about your intentions, and then ensuring that the financial advisor is assessing your intentions against what's actually been put into place to determine, is that going to shake out as per your wishes? And so, like I said, it is a two-way street, but absolutely clients should be asking and expecting this of their advisor. And to Colin's point as well, every advisor needs to work within their capacity of competence and skill set. And if this goes beyond the expertise of your advisor, that they are flagging that and referring you to the appropriate professional.
Perfect. Thank you, Julie. Same question for Evan.
Reiterating Julie's last point, it's often going to be a teams-based approach. You need not just a financial advisor, but you need somebody who has the competencies in a myriad of subjects such as insurance, taxes, estate law, and where applicable, trusts or corporations. The lawyer, while not dealing with financial planners, is going to be an integral part to this. They're ultimately going to be the one drafting the wills and the power of attorney. Having recently updated my own will with a young child, I have a 4 years old, you start to realize all the little specifics that you may not have thought of. If something happened to you right away, do you have, who's the guardian? That's simple enough. We might have thought of that. What if the guardian moves to another country? Just these things that may not have been thought of. So the role of the financial advisor is to bring up things that the client may not have thought of, but also that should be the role of all the other participants who need to help the client, including a lawyer.
Thank you, Evan. Colin, just to reiterate the question, what should clients ask of their financial advisors to help achieve and execute a smooth transition plan?
Well, just to emphasize the point that Evan made, I think there's two key questions that every client should ask their advisor. Number one, what have you seen people in my situation do differently than I'm intending? What's the things I haven't considered that you've watched other people do? And listen, because there could be something in there that triggers with you. And again, somebody with some experience is going to come to the table with a few stories that may, uncover some feelings or, help you better understand what it is you're trying to do. And kind of an ancillary question to that is, what mistakes have you seen people make in my situation? What kind of, problems, because again, being in the industry, things that go smoothly, well, those don't spend much time on my desk. Things that go badly spend a lot of time on my desk. So sometimes I'm more imprinted with mistakes that happen, and I'm really desperate to not let them happen again, because once you see negative consequences, you do your best to make sure that you don't repeat that experience, because that's just not fun for anybody. So asking for those questions about what else have people done like me and what mistakes have people like me made should help you inform the decisions and the framework that you're working with.
Perfect. Thank you very much. At this point, I think I'll move to the next slide, and I'll put this back to Sean. Sean, the question is, why should you seek advice from a qualified professional?
Hey, well, thanks, John, and just thank the panelists too for the insights they've provided so far. And I think there's been some really compelling information from the panel today. And there seems to be a common theme running through some of the discussion, and really just around the importance of planning for the future, clearly thinking through all the scenarios and circumstances around not just wealth transfer, but all that goes into kind of a comprehensive plan. I think we're learning that our financial landscape is complex, and it's probably more important than ever that people make financially responsible decisions. And if you look at buying a mutual fund or buying securities or setting up a mortgage is certainly one level of advice that advisors can provide. But I think as we've learned today from some of the topics covered, it's certainly an extra layer of expertise needed to kind of handle some of these situations. And when you think about what goes into planning for a transfer of wealth, there's lots to consider, and it's likely something that you've thought about for some time. And you may be wondering, do you have the information you need? Is the information you have in plain language that you can understand? And another key point from today is just, do you have that kind of roadmap in place that you can, looking to kind of maximize the benefit for you and your family? Do you have that in place? So I think there's certainly a few things that have stood out from the panel today, and just go back on a few key points there. Julie highlighted the fact that only 25% of Canadians have a will, and I think that's certainly an easy part of your financial plan to overlook. And tied to that, having a will in place is just the overall kind of family dynamic you have in place as well. Evan talked about clients not thinking long term enough about wealth transfer, not being top of mind until later in life. And it kind of goes back to that, that family dynamic about what you want to achieve, whether it's, charitable donations or just how you deal with your own kind of family needs. So having those conversations early so that you can land on those kind of shared values or other circumstances, kind of highlighting some of the differences you may have between family members and such. And then Colin talked about communication, and what I found interesting with his discussion there was really, a qualified advisors have that benefit of experience. They've seen, clients with differing circumstances, so they have that comfort level, which gives them the ability to kind of tailor their advice to fit your own unique needs. it's that perspective that a financial advisor can provide, and that, all three panelists kind of touched on that kind of quarterback approach where they have access to other professionals in other areas that will suit the needs and goals you have in place. So ultimately, I think planning takes discipline and commitment. Julie mentioned that kind of two-way street around between the client and the advisor. We all have goals and objectives, and I think that's a great first step. But then kind of planning how to approach a transition plan really does need the advice of a trusted and qualified person. So I think some of what we've learned today, and just in general, having the many different scenarios and circumstances and decisions you need to make, working with that trusted and qualified financial advisor can really help chart your course through your retirement journey. So I think those are certainly some of the key points that we covered today, and really highlights the importance of that role in your overall kind of financial plan. So I'll hand it back to you, John, for some further discussion. I know we've got some good questions coming in from the panel today, or from the participants today as well.
Yes, we do. We do. As a matter of fact, we'll move to the question and answer component of the webinar at this point. And as Sean mentioned, I do have a number of different questions that have come in. But additionally, for any of the participants still wishing to ask a question, please feel free to click on the Q&A button at the bottom of your screen and type in your question. So these questions will be open to all the panelists. Please feel free to jump in, or else I can designate you to respond to the question and move on to the next person. But I'll ask the first question here. The question is, if I designate my child as beneficiary to my RSP and or Tfsa, will the proceeds go to him or her automatically, with or without a will?
I can take that one. RSPs and TFSAs, as well as life insurance, they'll allow you to have a named beneficiary, as well as some pension plans. So that's not a limited to list. But where you are able to have a named beneficiary, those flow outside of the estate, and therefore they can go directly to the named beneficiary in absence of the will. However, I want to still reiterate the importance of a will for all of those other assets. So that's not going to solve the problem. And also what you'll want to make sure is that those beneficiaries on your RSP, TFSA, et cetera, are aligned with your will, because there's often situations where there is discrepancies between these, where you have identified different people as your named beneficiary versus what's in the will. And that's going to cause some issues that will need to be worked through. So the short answer is yes, they will go directly to your beneficiary in absence of a will, but the longer answer is make sure you do have the will and it is up to date and aligned with those beneficiary designations.
Perfect.
John,
Thank
if I
you.
could just jump in for
Anything to add, Colin? Yeah, go ahead.
Yeah, this is one of those things that I've watched go sideways, because again, you get a conflict between a will and a beneficiary. Everybody get a lawyer. We're off to the races. So, again, if you have a properly drafted will, that tends to be less problematic than trying to do both. The other thing I would point out is that your estate is still going to be responsible for the taxation on that RSP, unless it's a minor child, and again, that gets more complicated. So the estate's still responsible for the tax bill. So we've seen it where, a registered asset goes to a beneficiary and CRA goes looking for the taxes, and they aren't in the estate because the estate's been left without enough money. CRA knows where the beneficiary is. So again, you can create some unintended consequences, and you can cause, for what you're trying to avoid, the risks of causing bigger hiccups are fairly material.
Makes sense. Evan, anything to add?
No, basically, Colin is comments is what I was going to comment on, and that is, if you end up in a situation where you have a named beneficiary and don't have a will, if there is someone who disagrees with it, Colin said it perfectly, lawyers will get involved. So the will is a stronger legal document than a simple named beneficiary. And I can't see any case where you don't get a will. It just cements your wishes so that it goes to the intended people.
Very good. There's a part B to this question, and I'm sure much of what you already mentioned will apply, but there's a slight twist to it in the sense that someone is asking, if I'm looking at my non-registered accounts, in other words, bank accounts, GICs, investment accounts, and essentially anything that falls into that category, and I make the decision to gift part of those non-registered accounts in the form of making it into a joint account, what is the tax implication of that? And ultimately, will that pass to the surviving person once the initiator is deceased?
So John, I'll jump in, and the answer is I'm stealing your thunder, Julie. It depends.
I knew it.
That's my
That one is
favorite response.
Oh, that one's a tricky one.
But I will tell you that there is some, and again, this is, you're asking a legal question, and that this would come back to a lawyer. But I can tell you from some experience in some court laws, the courts will look at the intention of the designation of a joint account. Sometimes the intention is just for the ease of operation, similar to a power of attorney, but it doesn't endure through an estate unless it's been specifically set up as a gift or a pre-inheritance. So just the simple act of adding somebody to an account won't be sufficient to get you around having legal issues regarding the entitlement to the account. And that is pretty much the limit of where I should walk. So everything else is it depends, and talk to a lawyer. Did I miss anything?
Anything to add, Julie?
Yeah, I just echoing what Colin is saying, this one can be so tricky. And so, there's so many considerations that come in here, legal ownership, beneficial ownership, it can get really messy. And so it's just echoing what Colin said, get the right professionals. You can also have unintended tax consequences. Like this one can go sideways so easily. So I will just reiterate, get the right professional to take a look at your unique circumstances to kind of iron out those it depends factors and considerations.
Is the it depends component moderated if that account or the proposed joint account is in fact gifted in totality, as opposed to creating a joint account, if you will?
Well, John, you can gift money, and that's, it's no longer your money, it's somebody else's money. So
right.
Giving money from one person to another, that's, that's called birthdays, it's called Christmas. People gift money all the time. Sometimes the amounts are bigger. Again, we get down to lack of control, and if it's to gift money, if there's a deferred tax liability, to gift money without settling up the tax bill, I'm not aware of any situation that springs to mind where that's possible. But I mean, gifting money from one person to another, sure, that kind of stuff, it takes it out of your estate for sure, because it's no longer your money. But now you get to watch what happens to it, and just decide whether or not you want to be around to see what's going to happen to it.
Are there tax consequences in a gifting scenario where somebody, say, gifts a stock portfolio to a child or a spouse, in the true sense of gifting it? However, the stock portfolio has appreciated significantly from the day the individual securities were bought to the day they were gifted. What are the tax consequences in a scenario like that, if any at all?
Do you want that one, Colin?
I don't want to steal all the oxygen in the room.
Yeah.
No, most of the time that's a deemed disposition. Now, again, that's most of the time. Don't take this as, because again, every situation is different, and there can be nuances and trusts and all kinds of other situations set up. But the overriding, the way the Tax Act is structured, as assets move from one generation to the next, the deferred taxation has got to be caught up. So it would go to the next generation at a higher cost base. That's a generic tax guideline. But again, there can be very specific situations. And again, I'm walking right up to that line, and I'm going to say, talk to your accountant. I can give you the questions to ask and all that kind of stuff, but I couldn't hold myself out to be able to address all the nuances there.
So I guess in summary, the response would be there likely is a tax consequence, and speak to a professional about that.
Yes.
I can add to that. So there likely is a tax consequence, and yes, speak to an accountant. That's definitely true. But you did mention, John, examples of spouse and adult children. That brings an extra layer of complexity. So with adults, adult children, a gift is a gift, and while it may be taxable in the year in which you gifted, especially if there's appreciation, all future years, if they reinvest it in their name, it's now taxable in their hand. But spouse is the one I want to bring up, which is you could be liable for something called attribution rules. And attribution rules in simplicity is, regardless of the fact that the assets have been transferred to another party, the tax is still liable to the original participant. Yes, your spouse might have the assets. You're going to continue to pay the taxes inevitably. So if this was meant for tax planning, it didn't work.
Very good responses. Thank you. Moving away from, I guess, tax component more to being related to will, although this does have a tax edge to it, this particular question. And the question is framed around, if an individual owns a principal residence and passes away intestate, is the principal residence considered to be deemed disposed, or does the deemed disposition only apply to assets such as investment portfolios, cottages, investment properties, etc.?
So the deemed disposition will apply to the principal residence as well, but keep in mind, in Canada, our principal residence is able to appreciate without capital gains. However, a principal residence is still subject to probate depending on the province that you live in. So the value of the house as of the value of the principal residence as of the date of death is going to be subject to probate.
Yeah, a slightly different way of framing the question is, deemed disposition is assume everything you own is sold. And if the act of selling it creates a tax situation, then you have to deal with it. So in the situation here, it's, yes, it's assumed that the house is sold, but there's no tax consequence to it.
I don't know if the intention of the writer was to see if something that would have been tax-free is taxable because it was intestate. And if that's the case, the short answer is no. And that applies to primary residence and Tfsas. It doesn't become a taxable event just because you didn't have a will, although probate would now be in play.
Right. I think that was the nature of the question, Evan, was in the case of a principal residence where there is not that type of tax consequence, would it apply if one dies intestate? I guess is the short way I could have asked that question. Another question here that I find interesting, actually, there's several questions on this particular note. In scenarios where an individual does not have a will, how should either the children or spouse or maybe the individual themselves handle things like account numbers and passwords in the event that they pass away?
Do they even have these account numbers and passwords to begin with? Let's not forget, here in Canada, we have privacy laws. And so when I was left to deal with an intestate estate, it took 6 months for me to be appointed executor. And in that 6 months, I did not have access to anything of the deceased. I do not have access to their account. I do not have access to their information. You can't call and find out what's their cell phone account number, their cable account, how do I pay this? You have no access to anything. And so that's why it's so important to have a will, because not only is it about how your assets are going to be distributed, but it's giving permission to somebody to access your information and get in there. And so, I'd say, like, do you even have that? And so I would, highly suggest that when you're working on your estate plan, the world has changed, and you'll see a lot of talk these days around things like digital assets being part of your estate plan. And I know I just redid my will, not all that different than Evan, although mine wasn't children, just needed to update the will. But I included digital assets in my will as something that needs to be addressed now based in the world that we live in. So that one is a trickier topic, but I would say make sure that you have addressed it in your estate plan.
Evan, Colin, anything to add?
My recent will update also included digital assets. So I think a lot of estate lawyers are now just adding that as the go-to, whereas funny enough, maybe 10 years ago, it wasn't even thought about. One tricky side aspect, which the will doesn't take care of, is passwords. You can't just write a password in a will. So in my case, my wife knows my password. For those who know, LastPass just holds all your passwords. I'm not saying that's a great solution, but that's my solution.
Well, the only other comment I'd make, John, is that be careful. If you have access to something and you show initiative and go do what you think is the right thing, 6 months later, when the courts have finally determined who's getting to decide what, and you've done something that somebody disagrees with, you now have put yourself in the crosshairs. So, sometimes you're in a situation where, because of circumstance, you have the ability or you have information, and you could be acting with the best of intentions to try to do the right thing or do what you thought the deceased may want you to do. But if you do so without the proper legal foundation or legal backing, you're opening yourself up to the fact somebody could challenge your actions later. So just be careful about proceeding without having everything firmly set up, because again, families and money.
Indeed, indeed. We're coming up close to the top of the hour here. We've got about 4 minutes left, but I'd like to give Sean a few minutes at the end here. But I would like to squeeze in one more quick question here, if we could do a quick sort of round robin on this. We talked about principal residence earlier. I have another question here around considerations for transferring non-principal residents to beneficiaries while alive. In other words, cottages, investment properties. What are the implications for something like that?
Well, there's different ways to do that, whether you're adding somebody to a deed or transferring the property. I mean, again, this needs a legal and an accounting opinion, but you do open yourself up to the idea of a deemed disposition of the property and having to pay the taxes on it. Because again, CRA basically, when a tax deferred asset changes generations, they're going to be looking for their pound of flesh, because again, it's a tax deferred asset, it's not a tax free asset. And again, documenting the purpose of the changing of the ownership can be key. So you're going to need a good accountant and a good lawyer, because again, there's a lot of nuance there. Because again, if you guys paid $500 for that cottage 50 years ago and it's sitting on a lake and it's now worth 1.2 million, the stakes are big. What'd you pay for the cottage? Well, nothing really. I just kind of built it. Oh, okay. So your cost base is now zero. Right. So a good accountant is going to walk you through how to establish that cost base, and what the ramifications are from a tax perspective, and then a lawyer will speak to you about the purpose of the transaction and making sure that that's properly documented.
Any last comments on that question?
I will add communication with the children, especially when it comes to property. A cottage is a classic example. You have 2-3 children and you decide, okay, well, we had such great memories here. Let's just put all 3 children on the property. Well, you might have just made a mess. You pass away, it's owned by 3 people, they get married, there's separations, one doesn't even want the cottage, the upkeep with who should sell. So this should be a conversation. What if you found out one child just doesn't want it? Maybe that child should get assets in the estate, and if should 2 children get it, or maybe one. Again, speak to a lawyer on this, but you have to be careful when you have multiple beneficiaries on a property that's illiquid, such as a cottage.
Right, right. Julie, I apologize. We're down to the last minute here, so I have to
That's
leave
okay.
some time for some closing remarks on
Yeah,
Sean's
and I'll just
behalf.
maybe add one statement about it. If that cottage is in another province, you may want to consider having documentation, such as a will in that province to address it. So if you live in Ontario, you have a cottage in Nova Scotia, consider having a will in Nova Scotia to address
Key
it.
point. Thanks for adding that. Thank you. Sean, I'll pass it back to you for closing remarks. On my part, I'd just like to thank all the panelists for participating today. Great responses to all the questions and terrific information. And I'd like to thank all the participants wherever you're located. And we look forward to seeing you on the next webinar. Back to you, Sean.
Great, thanks, John. Excellent conversation today. So this, as John mentioned, concludes our event. Thanks again to our panelists, Julie, Evan, and Colin, and John for participating. Great insights, great questions. If you have additional questions, please email designations.csi@csi.ca on the screen there. There will be a replay of this event will be available in the coming days. For more information on upcoming webinars, please visit our website, csi.ca. I believe the next webinar in this series takes place next week on November 3rd. Thanks again for attending, and have a great day.